Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and we're getting an update today from Dave Kranzler, fund manager and publisher of the Mining Stock Journal and the Short Sellers Journal. And Dave, it's been a couple months since we've had you on the show. Great to get an update on how you're looking at the economy, the markets, and of course, the resource sector. I guess let's kick things off from like a wider big picture view of the economy. We've had a lot of economic data coming in. Now, if you think back a year or two back, everybody was waiting for a recession. We did have some dodgy periods where there was those 2 quarters of negative GDP, and we had a banking crisis in there with the regional banks. And a lot of people think that's all gone and we're going to have the soft landing. There was some deterioration in the economic data, though, over the last, let's say, 6 months where people were more concerned. But now we've had, of course, better than expected data on the jobs and on inflation and really on the economic health. The GDP forecast is still for 2.5% growth. So I know that we have to take all these numbers with a grain of salt, but because the markets react to the numbers we're given, how are you looking at the economic data as it's been coming in? What's the health of the economy?
I mean, the GDP is completely misleading. And I mean, not only do they massage the numbers for political purposes, the GDP deflator is completely understated because it's basically similar to the CPI. So if you were going to revise the numbers and use a real inflation index, so for instance, my fallback is John Williams' shadow statistics. He's got two alternatives, and he goes back and he recreates the way that the CPI was calculated in 1990 and in 1980. So if you just go back and use the 1990 version, that shows inflation running at just under 8%. So if you were to revise the GDP numbers using, that alternative inflation index, we'd probably have, other than say 2020 and 2021, when the Fed dumped 4 trillion into the financial system and the government was handing out money like Halloween candy to everyone, would probably have had real GDP growth has probably been negative since, I would say, probably 2018, except for those 2 years. So, and you can see that a lot of people don't pay attention to it, but the regional Fed banks put out their business surveys and manufacturing indices for their regions. And the most dramatic one has been the Dallas Manufacturing Index. And that thing's been negative since, I believe, going back to November 2022. So in that region, there's been a manufacturing recession since then. And most of the other indices, there's the New York Fed is called the Empire State. There's the Richmond Fed, the Kansas City Fed, and then there's the Chicago. Chicago puts out a national business activity index, and that's been more negative than positive over the last 3 or 4 years. So, and again, I scour these reports every week for my short sellers journal. And the other thing that kind of reaffirms my view that the economy has been sluggish for the most part, other than, the government spending side of it. If the government wasn't spending the amount of money, deficit spending the amount of money that they've been spending for the last couple of years, this economy everyone would acknowledge that we're in a pretty bad recession. So, and if you look at corporate earnings reports, especially the ones that sell retail oriented or consumer oriented, that sell products that are dependent on households having disposable income, they're all saying the same thing. Consumer spending is down, households are getting squeezed because of inflation, real wages are negative using a real inflation index. And so the side of the economy that's driven by household consumption, that also has been in a recession really probably since early 2022. Since the government kind of stopped doling out all the money that they were doling out to households during the pandemic period.
Yeah, Dave, and I think most people in their real everyday lives know that food prices in many cases have gone up 60 to 100%, sometimes more than that. Even fast food prices, there was some information circulating showing that most of the prices on the menu are up 80%, 130%, some items even up 150% on the fast food, 4 or 5 of the main carriers. I just went into the dollar store the other day and they're now $1.25 or $5. So we're definitely seeing the inflation. But when you look at the general markets, everybody has that Alfred E. Newman, what, me worry kind of look, because when you look at the markets, Dave, they've been hitting new highs. The S&P and the NASDAQ mostly carried by those mega cap tech stocks. But what do you think of the disconnect between people's daily lives and the market action that we're seeing in the general U.S. equities?
Well, one of the things that a lot of people aren't looking at is what the Fed's doing with the money supply. So the chart that circulates on social media is the year over year percentage change in M2. But if you actually just go into the St. Louis Fred website and pull up M2, you can see that M2 has been rising since early 2023. In fact, as of the end of August, it was at its highest level since February 2023. And so that, to me, that's a big part of the reason why we're back in this stock bubble. And despite the Fed's propaganda and the mainstream financial media saying, well, the Fed's had a hawkish monetary policy since they started hiking rates, that's actually blatantly false. The Fed's monetary policy has been very easy for the most part. Like, again, as we were discussing, if you use a real inflation index, even at 5% Fed funds rate, you still have negative rates. And negative rates are inflationary. And that's what's been juicing the stock market. And also, a lot of it is hedge fund algos, right? Chasing stocks higher. And that's because prime brokers are basically giving away money to hedge funds, in terms of lending them money. And that's also a big part of what's driving stocks higher.
Well, since you run the Short Sellers Journal, I'm curious, for years there's been people saying we should short the general equities, and there has been moments where that worked out, like in 2022, the big correction, or really the second half of 2021, a lot of the garbage IPOs and smaller tech stocks and, unicorns that were coming on the market, they all dried up at the end of 2021. So there were periods of time where you could short the small caps or the general equities, but for the most part, people that have been shorting the markets for the last dozen years have been wrong. Is there an opportunity coming up where this market is finally running out of steam? Are there any short selling opportunities on your radar?
Well, I mean, you're right. If you just short SPY, you've had your head handed to you, or if you short the QQQs or whatever. But if you're selective about and you do the fundamental research, there's been some great shorts over the last couple of years. For instance, Tesla has just been a phenomenal short since it's had stock splits. So it's down close to 50% from its all-time high, split adjusted high of 400. It's trading at 241 now, and it's been as low as 120 since mid 2021. So that's been a great short. If you do the fundamental analysis, you're going to find stocks that are worth shorting. Another one is Super Microcomputer. I fingered that one I think it was late January this year at around 800. It ran up to 1,000. It's since then did a 10-for-1 split, but so split adjusted, it ran up to 100, and it's trading at, in the low 40s right now, mid 40s, 46. And I think that one is going to easily get cut in half from its current price. There's fraud going on at that company. And in fact, the Department of Justice is probing them as we speak. And my guess is the SEC will get involved eventually also. So there's stocks like that. One that I just featured a couple of weeks ago is Harley Davidson, HOG. And so they extend financing, right? I put it in there at 36 and change. It's at 33 and change now. A couple of weeks ago, I put it in. They finance, I think it's something like 80% of their purchases, they provide the financing for. And they lay off as much of those loans as they can, but they also hold a bunch of them. And a lot of those loans are eventually going to blow up. And again, it obviously caters to the ability of a potential buyer to have disposable income to put the down payment for the bike and then to make the monthly payments. So that pool of buyers is shrinking as we speak.
Yeah, and I also think it ties into the concerns that many still have over loan defaults for auto loans, in this case, motorcycle loans, but also home loans and business loans. I don't think we're out of the woods yet. And a lot of people forget that while they've seen inflation rates tick down some over the last year, we're at prices that have compounded year over year over year that are at such higher levels. A lot of people's loans rolled over in the middle of that or partway through it or are still rolling over. And so compared to where they were, they're still seeing higher payments or people are having a harder time getting financed. So that's going to impact manufacturing, homes, auto sales, business loans, et cetera. Do you think that's been some of the strength that we've been seeing in the precious metals is people that are putting money into gold, seeing through maybe some of this economic data, maybe some of the weakness under the surface. And in addition to central banks, that's why also private investors have been stacking some gold. Do you think that plays into it, Dave?
Yeah, real quickly, let me just bring this up because you brought up the home builders. The home builders are more overvalued now than they were in the first housing bubble of this century. So they're more overvalued now than they were back in 2005, 2006 when, and that's when home sales actually started declining, was late 2005. And home sales have been declining even more quickly this time around, and yet the home builders keep levitating higher. And that's a sector that I kind of specialize in terms of shorting the market. And I traded the junk bonds of these home builders back in the 90s, so I'm very familiar with the fundamentals of the sector. And I think right now is just a fantastic opportunity to short home builders. I mean, you're going to take pain. I've been taking pain on my home builder shorts, but eventually you're going to be right. Yeah, in terms of gold, I mean, I think there's two big drivers there. And, sadly, the universe of US investors who actually buy physical gold and silver is very tiny. Most people, they buy GLD and they're like, yeah, I own gold, I own GLD. Well, you don't own gold if you own GLD, you own a piece of paper. But what's been driving it is probably first and foremost is the enormous physical demand coming from the Eastern Hemisphere and the BRICS countries. And almost all of the central banks in that part of the world, or those parts of the world, are buying just tons of gold. In fact, Poland even, which surprisingly, because they're a U.S. ally, they've been stacking, their central bank has been stacking gold. The Polish central bank now owns more gold than the Bank of England does. And also, gold has become, it's surpassed the euro as the banking industry's second largest reserve asset after the dollar. And eventually it'll surpass the dollar. And again, it's mostly non-Western central banks that are buying the gold. I don't know what the ECB's been doing. I don't think they've been buying gold. We know the Fed hasn't been because it would be disclosed. So that's probably the biggest factor. And then the second biggest factor is just central bank easy monetary policy. I mean, we just saw China just dumped hundreds of billions into their banking system. As I pointed out, the money supply here has been growing since early 2023, and that's what's driving inflation. And so I do think that large pools of wealth are stacking physical gold. And I think that's having an influence on the price. So, and I think it's inflation expectations, for people, for smart money. They see what's going on and they understand it. And the best place to be for that is gold and silver.
Well, and when you look at the West, it is different than the East, Dave. There has been a lot less participation in the West, but there still are countries and there still are individuals buying physical gold in Europe, in Canada, in the United States, in Australia, which we consider part of the West. But it's not to the same degree as the East. Now, when you look at the gold price, though, above 2,600 in the mid 2,600s right now, there is a lot of central bank demand in there, but there also are people in all currencies that have seen gold appreciate. Even the people buying gold, Dave, at Costco and Walmart that were chastised for it buying at 2,000 and 2,100 have seen that be a pretty good purchase. Do you think things like that, seeing gold being bought at mega outlet stores like Walmart and Costco, is changing people's tune in the West on investing in the yellow metal?
Yeah, that's a good point. I mean, I thought it was really interesting when Costco started selling those 1 ounce gold bars And they were actually selling it for a little less than the national internet-based coin dealers were. And the popularity of it actually took me by surprise. But again, I don't think that retail buying of gold and silver is really enough to influence the price at the margin. I think it's really supply and demand, where the demand is coming from. Well, Indian retail buying obviously influences the price of gold because India is the second largest importer of gold after China. And same with China. So, but you're talking about population bases of over a billion. So that for sure affects the price of gold. But I don't know that Western retail buying per se necessarily. I mean, I guess to an extent it affects the supply, but I just have never thought of it as being a significant factor in pushing around the gold price.
Fair enough. And I think that in the West, it's more pushed around by paper prices, as you were outlined.
100%
People buying
accurate.
futures, and yeah, so it's really the tail wagging the dog on the paper market to the physical in the West. But when we look at the other paper assets, which are gold equities, they haven't really performed as well as people would have expected at $2,600 and even $2,700 gold recently. A lot of people, if we had backed up the clock 5 to 10 years and told them in the future, gold's not only going to break 2,000, it's not only going to break 2,100, it's going to be up 2,600, 2,700. I think a lot of people would have expected 5x, 10x moves in a lot of the producers and even more than that in the juniors. Do you think there's a big catch-up trade coming in gold equities, or is this time different?
Well, there's a couple factors there. But first off, let me just start off answering the question by pointing out that since the end of February, GDX is up 50%. It's a quiet 50% because the mainstream media hasn't caught on to it yet. So you're not hearing about it on CNBC or in the Wall Street Journal. But I mean, 50%, that's outperformed in that time period. It's outperformed everything, right? So I think part of what the issue is that guys like you and I, retail guys, we're in the high octane stocks, right? And the juniors have for sure lagged. And to be fair, yeah, certainly the larger cap, the producing miners have completely lagged the move that we've had in gold and silver relative to the move that was made starting in 2008. But they've lagged up to this point. And I think one of the big factors there is the general stock funds, the Fidelities of the world and the T. Rowe Prices. They're too busy chasing the tech sector, right? So they're not even thinking about gold stocks right now. At some point, you're going to start to see the larger body of managed money funds are going to start migrating into the precious metal sector. And I think we've actually started seeing that to an extent. So for instance, you and I chatted about Viva Gold earlier, before we went live with the recording. And Viva recently did a financing. They've got it's a small open pit heap leach gold project in Tonopah. And one of the large participants in Viva's latest financing was a Hong Kong-based fund that's run by an Englishman who decided to sell all of his Chinese stocks. Obviously, short term, it doesn't look like a great idea, right? But I think long term, it's more of a fundamental view, and decided he wanted to put some of his capital into mining stocks. So he participated in the Viva Gold financing, and he'll probably participate in the future financings that the company does. And that's an example of a generalist fund that is gravitating into the sector. And when we start to see that become more widespread, I think that's when the real fireworks will start in the sector.
Well, let's talk about some of the other gold stocks that have your eye then, because I think a lot of people believe that when we see the third quarter numbers come in for the producers, it's going to be obvious to even generalist investors and analysts that, hey, these companies are clearly making money. These are the fattest margins they've had. A lot of companies have $1,000 plus margins, but that also gets money circulating down the food chain into the development stage companies, into the explorers, into the smaller producers. Are there any other gold stocks that really have your attention right now?
I mean, I think the last time I came on, I mentioned Cabral Gold, and any day now they're going to put out a PFS on their startup mine project, which is they're going to take the at and near surface, it's saprolite. It's basically, mud that has a lot of gold in it, and it's very cheap to process. And they're going to build a small mine operation that they'll use the free cash flow from to finance the development and the advancement of the much larger resource that's on the property. And this is the CEO was the co-founder of the G Mining Ventures, the TZ property next door. And he thinks that his project, QQ is the name of the project. He also co-founded that deposit. He thinks it's going to be larger, and it's already been shown to be higher grade than the G Mining Ventures adjacent mine that's operating now. So I like Cabral. I really think over the next, 3 to 5 years, maybe much sooner than 5 years, I think it's a 10 bagger. So I like that one. There's also one called Heliostar Metals. I don't know if you're familiar with that one. They're in Mexico. They also have a nice little gold project in Alaska, but they bought the, what was it?
They bought the Mexican mines from Argonaut spent out Florida Canyon.
Argonaut. I was trying to think of Argonaut. Yeah, they bought 2 Mexican mines from Argonaut, and one of them is Ana Paula, and that thing looks like it's just going to be a massive home run. They have an open pit permit on it, but they're developing the underground mine. So they're going to work on transitioning the open pit into an underground permit. They also bought 2 operating mines from Florida Canyon. And those mines, they don't have official numbers yet, because they can't get in there and really do what they want to do with the mine properties until they close the deal, which it should close the first or second week in November. But they get the credit for the gold that's produced from those 2 mines from the time they signed the acquisition agreement through the end of the year. And the CEO, Charles Funk, I had dinner with him a few weeks ago, said that he thinks that they'll get credit for 30,000 ounces of gold production. And so it's going to generate free cash flow as soon as they close the deal. And then next year, he thinks, and this isn't official or anything, they can't make anything official. He can't offer official guidance, but he thinks 40,000 ounces next year is possible. And he thinks that it should generate at the current gold price around 45 million in free cash flow. And that'll be used to fund the advancement and eventual building of the Ana Paula mine. So, at the current market cap, it's trading at like 2.5 times next year's projected free cash flow, which is absurdly undervalued.
Yeah, that was a really interesting transaction. I was an Argonaut shareholder. I had followed it for years, had gotten out of it, got in several weeks before they were taken over by Alamos Gold for their Magino property. Then Florida Canyon Gold had those Mexican assets that Heliostar purchased, those producing assets, as well as the Florida Canyon mine that Integra purchased. So now Integra has gone into the producer category, and so has Heliostar. Do you like that idea of a junior company that's got a development project? Because in the case of Heliostar, it was the Ana Paula project that they also got from Argonaut. But in Integra's case, it was the Delamar project in Idaho and their Nevada North and Nevada. In both cases, both companies were facing dilutive raises in the future, but then they both bought producing mines that are now going to be cash flowing and really high margins because of the high gold price. Do you like that strategy of juniors becoming producers to kind of bootstrap their development project?
Oh, it's incredible. The market still doesn't understand how cheaply Heliostar got those 2 mines for. So Florida Canyon had to sell their Mexican assets in order for the Integra deal to happen. And Integra got a great deal also. I spoke to George Salamis, is the co-founder of Integra, and he's the executive chairman. I spoke with him at length right after the acquisition was announced. And and again, they can't make any official guidance until they get the keys handed over to them, but the deal will close. He thinks, in addition to the fact that, as you point out, it's going to generate free cash flow that'll fund the taking Delamar to a mine construction decision. He said they were pleasantly surprised when they visited the property in terms of the exploration potential. And he thinks that there could be as much as another 400,000 ounces of gold to be found on the property. And I'm familiar with that property from the time that it was owned by Rye Patch Gold, which is no longer in existence. So, I knew that it was a nice little gold producing property, and now Integra has it. And to answer your question, that it seems to be kind of a trend in the industry where these juniors figure out a way to either acquire assets that can generate free cash flow, or in the case of Cabral Gold, they're just going to take the at surface high grade gold material and process it to generate free cash flow to build out the rest of the mine project. So yeah, no, I think it's a great strategy. I mean, at this point, Heliostar, if all goes according to plan, they're not going to have to issue any more shares until they build the mine. And even then, Charles Funk told me he thinks there's a chance they'll generate enough free cash flow that they'll be able to fund their share of the equity when they do the mine financing, the project, the project financing for construction. And George said the same thing about Delamar. He said, look, if this thing works out the way we think it will, we're not going to have to issue any more shares until we look to finance building the mine.
Yeah, I think it's a really smart strategy for these juniors because it takes away that financing overhang from these companies and that boring orphan phase of the development and then getting ready for construction. All of the permitting and metallurgical work and de-risking is augmented by a producing mine that's kicking off some, cash, but also leverage to the metals prices, and they get a better rating as a producer and a better cost of capital on the debt when they do decide to build their projects. So just an interesting strategy we're seeing deployed. We also just saw it in the nickel space and copper space recently, where Magna Mining did the same thing and just bought some producing mines in Sudbury to fund the development of their other projects. So just something we're seeing more in the junior sector. But we're talking about some M&A deals here, Dave, and I got to get you to weigh in on two silver transactions that we've seen just in the last month. We saw in early September, First Majestic make a move to take over Gato Silver, which is a high-grade underground mine in Mexico, back to their more one metal, one country theme after the foray into Nevada with gold with Jarrett Canyon didn't go as planned. And then we also just saw Silvercrest taken over by Core Mining. And Core Mining had mostly been focused in North America and the US and a little in Canada. They have one mine in Mexico, but now they've doubled down with a second mine in Mexico. Both of these are high margin single asset producers that gave investors a place to play the torque in the rising silver price. Now they've been taken off the game board. What does that do for First Majestic and Core Mining? And what does that leave silver investors with?
I mean, clearly the Los Gatos acquisition is going to help First Majestic and boost its cash flow. It was a good acquisition for them. And I think Las Chispas was a great acquisition for Core. I generally don't look at the large cap producers because I think most of them, for the most part, and this is a broad generalization, they're run like big bureaucratic corporations, and I don't think they necessarily. I mean, I know the Newmont and Barrick, they operate so that the C-suite can exercise their options and make money selling their shares into the marketplace. I don't think they operate the companies for the shareholders. So I haven't taken a close look at Core in a long time, but clearly the acquisition of Silvercrest for Las Chispas, it's going to give them a nice boost to their cash flow. And Las Chispas is wildly profitable at $30 silver. So imagine when we get the move from 30 to 50, how much free cash flow, and any of these silver mines for that matter, imagine how much free cash flow they're going to be throwing off when silver catches up to gold.
Well, you brought up when silver goes to 30 to 50. That's the big question on everybody's mind. Will silver make a new all-time high? Will it approach that $49 to $50 level seen in 1980 and also seen in 2011? And will it surpass it when you model out the moves in silver? Again, it's been encouraging lately, but it's nowhere near the highs, even though gold's been making new all-time highs all year. Do you think silver gets there, Dave?
It will. It's just a question of when. I mean, if you look at a chart of silver that goes back to 1980, there is just a massive cup and handle formation. And we saw gold break out of it had a cup and handle formation that started in 2012. And it broke out of that earlier this year. And we've seen what that did for the price of gold. Now imagine when silver breaks at this point, it's a 44-year cup and handle formation. Imagine when it breaks out of that. I mean, it's going to launch for Pluto when it does that.
Well, I think a lot of people listening will be excited if it just launches to the moon, much less Pluto. But
let's call 50 the moon.
and then Pluto, triple digit silver. Well,
Exactly.
a lot of these companies are highly leveraged. So even $1 increments at a time, if it goes from 32 to 33 to 34 to 35, it's going to be a big deal for the silver producers. But it's also a big deal for the economics of development stage companies. And we had talked about a couple development stage companies last time, but we didn't get to one of them. And I'm kind of glad we saved it, Dave, because it was New Pacific Metals. Now, New Pacific is traded on the TSX under the ticker NUAG and on the NYSE under the ticker NEWP. But New Pacific put out not just a PFS on its Silver Sands project, which is more developed, but it also just put out a PEA on its Carangas project. So it's got two different projects of merit. Both look like pretty interesting economic studies. It is in Bolivia, and some people may snub their nose at Bolivia, but we were talking off mic that really Bolivia as a jurisdiction has been improving the last couple of years. I know this is a stock you follow closely, so maybe break down the value proposition that you see with New Pacific Metals.
Well, I think New Pacific is absurdly undervalued versus what it has. And as you point out, I think the perception is jurisdiction risk in Bolivia. But if you do the research, Bolivia is surprisingly, I can't remember when the current government came into power, but it's surprisingly mining friendly. And they recently passed a new mining regulations that are going to facilitate making it easier to get mines permitted because the country wants to attract foreign investment capital into the country, and mining is one of their big industries. So they're trying to facilitate that. New Pacific, as you pointed out, they just put out a PEA on the Carangas silver polymetallic project, and my understanding is the guy who heads the government they call them departments. So the province where it is, he really wants this mine to happen. And he's been working with the company in terms of helping it to hopefully eventually get permitted. But I got some numbers here because I actually just wrote this up in my last mining stock journal. The MPV on the PEA, and you got to take it with a little bit of grain of salt, and it'll change as they further refine the economic studies, is 748 million using $30 silver. And then that compares to the current market cap of New Pacific, which is 263 million. And that doesn't include the other Silver Sands project, which has the MPV on its PFS is, over 500 million. So you're looking at 1.24 billion of potential NAV here against a $264 million market cap. This thing is trading at 0.21 times its NAV, and back in the good old days, when the market was, the 2008 to 2011 period, typically, companies that had projects like this would trade at 50 to 60% of the net present value of the PEA or the PFS. And so I think this stock has that re-rating ahead of it over the next 12 months. So my view is, I think, assuming that the bull market in gold and silver remain intact, I think this stock has at least a double over the next 12 months. And then the backdrop here is Silver Corp owns I think 24% of the equity. And I've chatted with them about this on several occasions. And I think if either one of these projects gets permitted to build and operate a mine, I think that's the trigger point that'll trigger Silver Corp into acquiring the entire company.
Yeah, I'm glad you went there, Dave, because I was going to ask you, do you think that Silver Corp would make a move? But you're right. Maybe it'll take that permit process approval where they know they got the green light to build the mine. And maybe that is the trigger point. I also have a question on these economic studies, and not just for New Pacific Metals, but really for any of the gold and silver economic studies that we all review. It's the metal assumption prices. And I've talked to some other folks about this, but even on this new Pacific study, they're using a base case of $24 silver. Well, obviously, we know silver is above 30 and has been as high as 32.50 lately. And if we think it's going higher, at what point is it appropriate for silver companies to start using, higher prices, $26, $28 silver, or at least include the sensitivities to where spot prices are? Same thing for gold, same kind of question. A lot of companies are still using $1,400 or $1,600 base cases. Like, yeah, we get it. It's still economic at lower prices, but I don't think anybody's expecting gold to be at $1,400 or $1,600 anytime soon. We're at $2,600. So where should the metals assumptions be used when you're evaluating these economic projects?
Well, the issue is that the regulatory body that governs mining accounting and mining company public disclosures, these companies have to use like the 3-year trailing average of the price when they put out these economic studies. And so that's what drive, if you look at when they put these studies out though, if you look, they show sensitivity analysis. So the base case has to be based on the 3-year trailing average of the prices of gold and silver. But they'll also put out a higher end case. So for instance, on the Kranzler project, they showed what the NPV would be using $30 silver. And I understand, yeah, I'd like to see what it looks like at $32 silver, but I mean, silver's volatile. I mean, it was at $32 last week. It's at 31.30 now, right? It's up 63 cents right now. So it was below 30. So, it makes sense to use your high end case, even put that below the current price of where the metals are trading. But yeah, I mean, on the assumption that, the prices keep moving higher, and I'm pretty confident they will. I mean, these projects become just infinitely more valuable at even higher prices.
Well, and I know a lot of companies say that they use the long-term consensus prices, and maybe that's similar to the 3-year trailing, but they just moved whatever organization does the long-term consensus. I think it's 40 different analysts. They aggregate the price. They moved it from 1950 to 2050 gold. Again, $1,600 gold is nowhere close to 2050 long-term consensus pricing, much less where the spot price is. So as investors, when we're looking at it, we hear every day, Dave, that the markets are forward-looking, that they're discounting the future. So I don't think anybody actually believes that these companies and projects are going to be producing at $1,600 gold or $24 or $22 silver. I think they all see where things are headed. And so in the 2016 rally, when we had that 8-month rally from January to August of that year, there were companies that were trading above the expectations of where the NPV was for the project because people thought the metals prices were going higher. Why is it so different this time where not only are we nowhere even close, but we're at a fraction of where the NPV is on these valuations? Why is it so different this time?
Well, you opened up that Pandora's box. The 2016 rally, and also we had a similar rally starting in March of 2020, if you remember. That one only lasted, I think, 6 months because I think it fizzled out in September. If you look at the character of those rallies, speculative money just flooded into the juniors. You had junior, penny stocks that were within 3 to 6 months were 5 baggers. And when that was going on, I looked at it and I'm like, I wish this wasn't happening like this because this is not a sustainable move in the sector. And there's going to be a correction. And lo and behold, that's what happened. If you look at it this time around, as I pointed out, GDX is up 50% since the end of February. But a lot of the hot money, a lot of the speculative money hasn't shown up yet. And so, and there have been some good gains in the juniors, like Heliostar. I mean, it's doubled since early September. Viva Gold is up probably about 65, 70% in the last month and a half. So Cabral was at 8 cents when I really started pounding the table hard on it less than a year ago. So you've had some individual penny stocks that have made some good moves, but it hasn't been widespread. And, again, I think it gets back to, I think the market at large doesn't understand how undervalued these mining stocks are because they're looking at the numbers based on 1,600 gold or $20 silver, right? And it's at some point the market's going to wake up to this. And if you're investing in these companies now, we have that ahead of us.
Well, that is exciting, but I think a lot of people listening, Dave, will say, I've been waiting for years. When are you guys going to tell me it's going to happen soon? So, do you think that there's a momentum play here? Because we know that when momentum starts in any sector, regardless of what industry it is, it just brings in the money chasers, it brings in the hot money. Do you think we'll finally see a meme stock like, AI stock like, cannabis stock like, crypto stock like move in the mining stocks again?
Yeah, I mean, we will. It may take NVIDIA missing earnings, which, that the CEO frauds the numbers anyway. So I don't know if they'll ever miss, but at some point, the market's going to say this is BS. And, it's going to take the tech sector down and it's going to look for the next sector to put money into. And I think you'll start to see, when the general stock market rolls over, and this is what happened in 2008, right? The 3-year move in the mining stocks started in early November 2008, and the S&P still went down, I think, another 20-25%. It didn't bottom out until March of 2009. So at some point, reality is going to hit the general stock market, and I think you'll start to see a lot of capital move out of the general stock market and move into the mining stock sector. Because, I mean, even with the move that we've had this year in the sector, these mining stocks are still relative to the price of gold and silver and relative to the S&P 500. They're still almost as cheap as they were back in 2001.
Well, I think we're going to wrap it up there for today. I mean, we could keep talking forever on this, but I think it's a great point that you make. I think that the undervaluation in the sector eventually gets recognized. Maybe for now it remains a stock picker's market, but there is eventually going to be that tide that comes in that lifts the sector overall. And we are seeing the early stages of that in the producers, in the GDX, in the SIL. And after Q3 earnings come in, hopefully we'll see a few more people have a light bulb go off that this sector is finally in a fat margin environment. And I always appreciate getting your thoughts, Dave, on what companies have your attention and how you're looking at the markets. And if people want to follow along with Dave's work, definitely click on the link below this. It takes you over to his site where you can learn more about the Short Sellers Journal and learn more about the Mining Stock Journal, where he covers a lot of the stocks that have his interest in the resource sector. Dave, always great having you in the show and looking forward to our next conversation.
Thanks, Chad. Always great coming on the show. I appreciate it.